Next topic we have is fair value measurement. We'll be discussing first the overview of fair value terminology, fair value measurement framework, disclosures and exceptions. The US GAAP has created a set of rules and systems for how to calculate and disclose the fair value. What is fair value? It's the price at which an asset could be sold or a liability could be settled. However, there are certain exceptions where these fair value rules do not apply. The first one, share-based compensations, means payments made to employees or others in the form of company shares or sometimes stock options. For example, when companies give employees stock and bonus as a part of their compensation, a measurement based on or using a vendor-specific objective evidence of fair value. Means when the price is determined based on agreements or maybe evidence from specific arrangements with vendors or suppliers rather than using the open market. We'll discuss it as we proceed. This is relevant if a company has a contract with a vendor for a unique product for which there is no market price. And then the third one, fair value measurement used for lease classification or measurement. In some cases, where a company is classifying or measuring a lease, the general fair value rules are not applied. For example, determining if a lease should be classified as an operating lease or as a finance lease. So these are the specific cases where the standard fair value rules are not applicable, they are not used. Fair value defined. What is fair value? Let's say there are two parties, A and B. A sells a certain asset to B. The amount that B pays to A in an orderly sale, means there is no forced sale. A and B are not under any compulsion or under any distress. So the price that A receives and B pays, this is what you call the fair value. Right? So fair value is the price that would be received by A to sell an asset or maybe pay to transfer a liability in an orderly transaction. Orderly transaction means there is no stress, no problem with A and B to go for a forced sale, right? For example, if you own a building, right, and you want to sell it, the fair value is the price you would get in a typical orderly sale in the market. It's not like a distressed sale like an auction. So that's the key point you need to remember. Okay, it says fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction. That's exactly what I've explained. Then let us discuss this from different aspects. Fair value is measured for specific assets or liabilities or a group of assets and liabilities. What does it mean? It means a company might determine the fair value of a single machinery, a single piece of machinery, a specific asset, or a group of investments, a portfolio of investment securities. So it could be just for a single asset or a group of assets. Okay. Fair value is the market based, not entity based. What it means that when determining the value of a product for sale, you would look at the market prices, not the value it holds for your specific company. So this is the important point. The price is market driven, market based. Fair value is measured in the principal or most advantageous market. Now this is the key point. If you are selling shares of a stock, fair value is based on the stock price in the primary stock exchange where it is traded, or the market that gives you the best price. Like I have three markets, A, B and C, let's say. So most advantageous, I have a share that has a price of maybe $50 here, 52 here, and let's say 51 here. So I would sell it in the most advantageous market. So this is my fair value. This is the fair value, right? That gives you the best price. Next we have fair value is an exit price, not an enter price. What it means? Let's say if you are a company and you are selling a machinery, fair value is the amount that you would receive to sell it. This is called the exit price. Not what you pay to buy it, that's the entrance price. So it's the exit price, the price you pay, right, when you sell an asset, not the price you pay when you buy an asset. That is the key point. Then fair value includes assumptions that the market participants would use, including risk factors. What it means is that when selling an asset, a business would account for risks like market fluctuations of price or competition, what are the competitors' pricing, which potential buyers would also consider. So this is an important aspect of fair value. Fair value does not include transaction cost, but may include transportation cost. It's fairly straightforward. Like if you're selling a piece of heavy equipment, transportation cost to deliver it to the buyer might be included, but commissions and legal fees related to sales are not included. The fair value of a non-financial asset assumes its highest best use. Means let's say if a plot of land may have its highest and best use as a commercial property, even if it is currently used for agriculture. So fair value would reflect this potential use, the highest price as a commercial property. The fair value of a liability includes non-performance risk. What it means is that if a company has a loan, fair value would consider the risk that the company might default or fail to meet its repayment obligations. Fair value of an entity's equity instrument is measured from the perspective of market participant. Okay, what it means? Let's say if a company issues stock options. So the value of those stock options would be based on how a market investor would value them, not how you as a company view them internally. And then finally, fair value assumes that liabilities or equity instruments will remain outstanding at the measurement date. Means when valuing a company's debt, for example, fair value assumes that the debt remains in place as of the measurement date and will not be settled early or maybe not cancelled early. Okay, then some terminology, fair value terminology, orderly transaction. We have used this term before. What it means exactly? Let's say if a company wants to sell a piece of real estate. So what they do, they list it publicly, market it for a few months, let's see, to find some buyers, and then negotiate with buyers. This would be considered an orderly transaction because it follows the typical process where you offer a certain item to sell and then many buyers contact you and then you negotiate. That is orderly transaction. There is no forced sale or forced buying. That's the key point. Market participants. Take an example. Let's say if a company wants to sell an equipment, for example. The market participant would be companies in the similar industries or maybe individuals interested in purchasing that particular equipment. They know the equipment's value and they will buy or sell based on what benefits them. That's what we mean market participants. Then principal market. It's the main market where an asset or liability is sold. For example, if you are selling stocks, for example, the principal market is the New York Stock Exchange, or maybe Pakistan Stock Exchange or XY Stock Exchange, where the largest volume of trades occur. You would use the stock price from that particular market, let's say New York Stock Exchange, for fair value measurement. Even if you could sell it in other stock exchanges. Let's take an example that should make more sense. Look at this. Gaiety Incorporated holds Foxy Company stock, which trades on two exchanges. That means Gaiety can access both the New York and London markets. The stock price and transaction cost at the measurement date are as follows. In New York Stock Exchange, this is the quoted stock price, transaction cost is 6, and the net amount is for 52 less 6 is 46. And in London, the stock is quoted at 50, transaction cost is 2, net is 48. So determine the fair value of Foxy stock if the New York is the principal market or if London is the principal market and if there is no principal market. If New York is the principal market, then this is the $52. This is the fair value. If London is the principal market, then this is the fair value. And in this case, last part, and that there is no principal market. If there is no principal market, then we are going to see the situation that is most advantageous. Is it 46 or 48? Yes, this is most advantageous. In this case, London, $50. This would be the fair value if there is no principal market. So again, if New York is the principal market, this is the fair value. If London is the principal market, then this is the fair value. If there is no principal market, then we are going to select the price having the most advantageous results This is the best result, 48. This is not the fair value, this is. So this last point, most advantageous market, has been covered with this example. Let's move on. Highest and best use. First, non-financial assets. Let me explain with the help of an example. Let's say a company owns a piece of land and it's currently used for farming. However, the market suggests that the land could be more valuable if developed for commercial building. In this case, the fair value of this land would reflect its potential for commercial development, as that is the highest and best value. Let's say as a piece of agricultural land, it has $100,000 value, but once developed into a commercial land, then it may have, let's say, $180,000. Then this is the fair value. Then what about liabilities and financial assets? Let's take an example. Let's say if a company owns stocks in another business, and the value of those stock is based purely on the stock market itself. So then there is no alternative or commercial use. There is no better use for the stock themselves. So the concept of highest and best use doesn't apply to liabilities or financial assets. Let's see an example. As a part of business combination, a reporting entity acquires land that is currently the site of a factory. Similar sites in the area were recently developed for other purposes, including residential and retail space. The highest and best use of the land would be determined by comparing both of the following. First, the value of the land is currently developed for industrial use, that is value of the land plus the value of the assets, liabilities related to the land such as building cost, debt on the building and so on. This is the first value. And second, the value of the land as a vacant site for residential or retail use. The cost of tearing down the factory and any related cost must be considered, as well as any uncertainty in converting the land to a vacant site for residential or retail space. Whichever of these is higher would be considered as a fair value. Fair value will be determined based on whichever use results in the highest value. Next, we have fair value measurement framework. First, valuation techniques. The point is, when determining fair value, you should use different methods based on the type of asset involved or maybe the type of liability. The main technique are the market approach. That's the best. Then we have alternative. We can use income approach and cost approach. We'll discuss all these. Market approach, income approach, and cost approach. So let us first discuss what is valuation technique. So we have these three options. Whichever method you choose, market approach, income approach, or cost approach, the chosen method should make use of the observable data, things you can see like market price, and you should avoid using unobservable data, that is just the situation where you use subjective ideas based on assumptions. No. So if a company changes how it values something, it's treated as change in estimate, like we discussed previously, change of accounting estimate, change of accounting principle. So means it's applied moving forward retrospectively in financial statement, not retroactively, right? So let us discuss these one by one. So if a company is trying to value a piece of real estate, they might look at similar properties. This is the market approach. They might consider the income it can generate, that is the income approach, or they can estimate the cost of replacing it, the cost approach. Let us discuss these one by one in depth so you know what exactly it means. In market approach, we use the actual prices and data from the market transactions involving similar assets. For example, if a company wants to sell a machine, they could use the market approach by looking at the prices of similar machines that have recently been sold in the market. If a similar machine was sold for $50,000, let's say, the company might estimate that their machine has a fair value close to this amount, $50,000. Next, we have income approach. It estimates the fair value of an asset or a liability by calculating the present value of the future cash flows or earnings that this asset will generate. For example, if a company owns a rental property, they can use the income approach by estimating the future rental income from that property. So they would then discount those future rents to their present value using some appropriate discount rate. So that would be the fair value then. The third is cost approach. A cost approach determines the fair value of an asset based on how much it would cost to replace it with a similar asset at current price. Like a company is valuing a piece of machinery, they can use the cost approach by estimating how much it would cost to buy a similar new machine. If the replacement cost is, let's say, $100,000, this replacement cost would be the fair value of machinery. Next, hierarchy of inputs. Hierarchy of input means a system used to rank the quality and reliability of information that we are going to use to determine the fair value. Level 1 being the most reliable amount for fair value, and level 3 being the least reliable. Let us discuss these one by one. When you talk about level 1 inputs, level 1 input are quoted prices in the active markets for similar assets or liabilities. These prices are the most reliable because they come from observable market-based transactions. They are the most reliable, so I give them 5 stars. For example, if the company owns publicly traded shares of Apple Incorporated, the price of stock listed on the stock exchange would be considered as a level 1 input because it is an actual market price. Level 2. Level 2 inputs are other observable data, but not directly from the active market for such assets or maybe such liabilities. These include quoted prices for similar assets. Let's take an example to make some sense out of it. Let's say if a company is valuing a building and there is no exact sale of a similar building recently, so they might use data from similar but not identical buildings in the area. Or maybe if you are valuing a liability, like you are valuing a bond, for example, and this bond is not listed or it's not in the active market, so we might use the quoted price from bonds that are similar in risk and its duration. So this is another possibility. Then we have third level inputs. Third level inputs are unobservable data, and they are based entirely on your hunch, entirely on your assumption. Like, for example, if a company owns a highly specialized piece of equipment, right, and this equipment has no comparable sale or any market for such an asset, so we would have to estimate valuing some internal models, some assumptions, some hunches, I would say. So this is level 3. So level 1 is the most reliable, level 3 is a 1-star valuation. Next, we have fair value disclosures. What is the purpose of these disclosures? Of course, the company would like to give information to users of financial statements about the assets and liabilities that are measured at the fair value. So what are the key points in this? Valuation techniques and inputs used to measure fair value, including judgment and assumption. This should be disclosed. For example, if your company values property using the income statement approach, it needs to disclose that it forecasted future rental incomes, what are going to be, and the discount rate we used to calculate the present value. So you need to disclose how you have come up with the fair value, which level, I hope you remember, level 1, level 2, level 3, which level did you apply. The second key point to be included in disclosure, uncertainty in fair value measurement as of reporting date. Means if, so which of these levels do you think there will be more uncertainty? Clearly in level 3. So if you have used level 3, if company uses level 3 input, where you use some internal assumptions to value a unique asset, why? Because there is no market data available. So then you must disclose that these estimates could change significantly based on future conditions. Then the third key point, how changes in fair value affect the entity's performance and cash flows. Yes. For example, if a company owns a financial asset that are subject to large changes in market value, let's say you hold equities which are accounted for as a trading security, so you must disclose how these changes could impact profits or liquidity in the future periods. So these are the key points. Then specific disclosures are discussed, and we are going to talk about them one by one. First, quantitative information about significant unobservable inputs. Like if a company values a custom piece of machinery, specialized piece of machinery using internal estimates, because there are no market prices. So then you need to show the data they use, like cost, estimates, useful life. Second, discussion of the sensitivity of level 3 measurements to changes in unobservable inputs. Let me explain with the help of an example. Like if changing the discount rate, like maybe you use 10% discount rate, so maybe if you use 1% lower discount rate, it would drastically change the value of the asset. So the company needs to disclose the sensitivity, that the valuation by just 1% up and down, how drastically can it change the value of the asset or liability. Then the third, specific disclosure, information about non-financial assets and liabilities where measurement differ from the highest best use. We discussed this highest best use earlier. Like for example, a company owns a piece of land, which is clearly a non-financial asset, that could be used for commercial development, but that piece of land is currently being used for farming. So then you need to disclose this, because the fair value might be lower than it could be if used differently, because right now we are disclosing the piece of property using as a farming land. Then we have a hierarchy for items not measured on the balance sheet but disclosed in notes. Like if a company discloses that there is an asset and potential sale of that asset that are not listed on the balance sheet, so they must classify the fair value based on where it falls in the hierarchy. You need to tell which of these, level 1, level 2, level 3, does that specific asset fall. Exceptions to fair value measurement. Where do we not apply fair value measurement? When it is not practical or practicable to measure the fair value, like if a company owns a highly specialized machine that is rarely bought or rarely sold. It's a very unique machine. So finding market data for determining its fair value might be impractical. So in this case, that you don't need to use, you don't apply fair value. Then fair value cannot be reasonably determined. Like company holds shares in a private company which is unlisted, and since this company has no way to find its value, there is no recent transactions or any comparable companies to refer to, so the fair value, those shares cannot be reasonably determined. So this is an exception. Finally, fair value cannot be measured with sufficient reliability. Means there is no way that we can find reliable measure of fair value. Like if company attempts to value an asset based on internal forecasts that are highly uncertain, like I hold a piece of property and I want to estimate its rental value. It's not currently on rent. That rental value is subject to speculation. There is high level of uncertainty that may not be the actual cash flows in the future. So it might be hard to measure the fair value with enough reliability for financial reporting purpose. So this is also an exception. And that completes your topic.